Hello, everybody. Welcome back to another update. This is the February 2024 macro update. I'm your host, Mayur Thaker. I am an equity strategist here at Zacks Professional Services. And today's subject is an update on the ongoing macro situation that I am seeing. This is just my opinion only. But if you've been following me here, I've been very bearish on the macro picture, and I've also been wrong from a price action standpoint as the market has continued to rally over the past year since I started forming my recession thesis. And this is another update. We're now into February of 2024, and the same situation seems to be continuing. So I am now starting to see, as I've reported before, cracks that are forming in the job market. But the soft landing scenario, again, this is the scenario that we have, swiftly and steadily decreasing inflation back to the Fed's target of 2% per year without overshooting into recession. So that's what the soft landing scenario is. So the soft landing scenario with accelerated earnings growth, right? Accelerating earnings growth remains the dominant market view. That's the market view as of right now, but what my perspective is that we're still on track for a recession, and my dates have been pushed back. Originally, I thought that would happen in Q4 of 2023. That never happened. Now it looks like it's going to be delayed by a year. So I think that the recession that I thought would happen last year eventually will happen, because you can't continuously ignore leading macroeconomic indicators, and they continue to be moving in the wrong direction. Now, I will say that many of them have improved. So there is a risk to the thesis that I'm putting together, and I'm here to report the changes in all of those indicators. So let's get started with today's presentation here. So again, why do I still believe that we're entering recession? There are these key broad themes that I've been watching. Manufacturing activity is a leading indicator for in terms of the business cycle. That's been in contraction now for 15 months. That's based on the ISM manufacturing PMI. We've had an inverted yield curve that's persisted now for 20 months. We're now entering the 20th month of an inverted yield curve. The inversion of the yield curve based on the 2s, 10s has called 7 out of the last 7 recessions correctly. And I don't think that this time is any different. We're now entering month 20. Remember, this is a leading indicator, but what, isn't often enough conveyed is that sometimes it can lead by 2 years, which was the case in 2008 when this yield curve inverted in 2006. So that's something that I didn't, convey clearly enough in my past webinars here. And that's, my mistake, where I was, calling for a recession, imminently. But if you look at the history, the yield curve inversion can happen, multiple years in advance of the actual recession starting. And so it looks like this time is a similar time like in 2008. Not saying that the recession will be as bad as 2008. I don't think that's happening. I don't think that that's going to happen, but it looks like we are getting a 2-year advance notice based on the yield curve inversion. So what I should have done in my analysis is, instead of sounding the alarm when the inversion happens, I should sound the alarm when the re-steepening happens after the inversion. So after we spend a decent amount of time in inversion, say more than 6 months, when it re-steepens back above zero, that's when things get imminent. That's when the recession becomes imminent. However, it hasn't, reverted back up yet. And so the wait continues with regards to when the recession starts. The leading economic index, this takes into account multiple things, including manufacturing, the yield curve, the credit cycle, things like that. That's been in contraction now for 18 consecutive months. Excess savings continues to be depleted. This is what's been supporting retail sales, and the trend is not good for excess savings. So as consumers draw down their excess savings, there is a limit to how much they can spend, because right now they're spending well in excess of their income in terms of their the rate of growth of spending has exceeded the rate of growth of income. We know that because real personal income has lagged behind real personal consumption growth. And that's why we see excess savings declining. It's well below trend now. And it's forecasted to be depleted by the first half of this year. So we'll see what happens with that. GDI is oftentimes a leading indicator of GDP. That's been in contraction as of Q3. We haven't gotten the Q4 data yet. But despite 3.3% growth GDP last year, GDI is actually at best zero right now in terms of growth in 2023. That's a big disparity. That typically only happens around recession. Employment, the leading indicators of employment are entering contraction. We'll talk about that. And credit remains in contraction. And we also see rising loan loss provisions. We'll talk about that as well. So these are the reasons why I still think that recession is the likely outcome of all of this, despite the fact that the markets hit all-time highs. Keep in mind, that has happened before. When we see leading indicators, flashing recession, we have seen markets hit fresh new highs. That's what happened in 2007, when, remember, some of these leading indicators went bearish in 2006, early 2007. The market peaked in December of 2007. So we continue to have, a market set fresh new highs despite, multiple and increasing number of leading indicators flashing warning signs. So that can and has happened in the past. So here's the yield curve update. So February is now the 20th month of inversion, but as you can see here, the inversion happens and can happen well in advance of the recession starting. Here we saw the first inversion happen in 2006, and we didn't have a recession officially begin until 2008. Same thing back here. The yield curve inverted in 1999. The recession didn't start until late 2000. So that was about a 12 to 15 month advance notice. Here we saw this happen. The yield curve inverted in 1988, and we didn't have the recession until 1990. So that's another 2-year advance, warning sign. So what I should have done in my analysis, and what I should have conveyed to you all, my audience that is watching this and reads my weekly columns published on Zacks.com, is that it's not the inversion that we should be fearing. It's the spending some time in inversion, maybe say 6 months at least, and then having a re-steepening, meaning it goes back above zero. When that happens, that means that the short-term interest rate, the 2-year yield, is falling much faster than the 10-year yield is. And that's when, things get really, really rocky. And as you can see here, after we spend some time in inversion, when we get that re-steepening, that's when you get a much, much closer look at when the recession might be starting. So that gives you a much closer near-term forecast of where the economic cycle is headed. We're still in inversion right now, so that has not yet re-steepened. So, recession is still at bay as of right now. But it's something to keep a watch on, because the inversion is telling you to keep a close look at what's going on. Now, here's a major update for Q4. This is the reason why the market is so strong, and that's because we had Q4 earnings come in, and that was well above expectations. If you recall, entering the quarter, the earnings season, analysts had slashed their expectations for earnings growth from 5.5% to 0%. And now here you see, this is the latest update as of this week. Companies that have reported so far are showing almost 4.5% earnings growth year over year. So we're almost back at the peak of where analysts were expecting when they were at 5.5%. Not quite at 5.5%, but still 4.5%. Much better than what analysts had thought, entering this earnings cycle. And that's riding on the backs of 2.9% revenue growth. So the revenue growth has been accelerating earnings growth has been accelerating from Q3 to Q4 now. So analysts are looking for a little bit of a pullback in terms of the growth rate, but still we're adding to the earnings per share. So it's still growth year over year, just slightly tapered back, followed by a big, turn up in the growth rate. So right now, analysts continue to expect an accelerating rate of change in earnings. And that's based on so far, back-to-back quarters of accelerating earnings growth. First from Q3 over Q2, and now from Q4 over Q3. However, here's the caveat to this. If you exclude the Mag 7, right, these are the big cap, mega cap tech stocks here, earnings are a much, much different picture. We had a 3.5% drop year over year in Q3, and that actually worsened to minus 4.1% in Q4. So we can see here that the vast majority of the growth is coming from the big 7 companies that dominate the indexes. So this needs to improve. However, analysts are expecting even this group to improve. And right now, the market believes that. So as of right now, even though, the numbers got worse in Q4, based on, the commentary and the outlook by managements, analysts are remaining optimistic for 2024. And here we can see, earnings starting to accelerate beginning in Q1 of this year, 2024, accelerating all the way up to 7.7% in Q2. Again, this is the S&P 500 excluding the Mag 7. So this remains the dominant narrative right now, is that despite Q4 earnings being quite bad without the assistance of the Mag 7, these companies still continue to be, analysts still continue to expect a very, very strong 2024 earnings recovery after a very subpar year in 2023, where we had negative earnings growth. And that was it's clocking in at about minus 2% year over year, including the Mag 7. So excluding the Mag 7 is much worse than that. Now, here's the other thing that we're noticing here. There's been several very interesting warnings coming from credit card lenders. So remember, American Express and Discover are both a credit card company, meaning a payments company, that supplies the railways, the network for payments and settlements, but they're also a lender as well. This is in contrast to Visa and MasterCard, which only provide the network railways for payments and processing, but they are not a lender. So if you look at the lenders that are also credit card providers, American Express and Discover, they are both reporting very sharply increasing loan loss provisions. Discover is especially bad because Discover actually is, they supply credit cards to the lower end of the spectrum, meaning they have their entire business model built on providing credit cards to middle-class American families and individuals. So Discover has over 60 million credit card holders, and they have a much, much stronger pulse on the middle class, on the health of the middle class, than pretty much any other company out there, I would say. If there's any other company that is a bellwether for the financial health of the American middle class, it is Discover, with 60 million cardholders. And they are now reporting that, as of Q4, the total loan loss provisions more than doubled from 900 million in Q4 of 2022 to 1.9 billion in Q4 of 2023. That was a shock that sent the shares down 10% on reporting those Q4 earnings results. The same thing happening with American Express, despite the fact that American Express deals with a very different group of people. They deal with mostly the affluent, and even they are reporting rising loan loss provisions. So this is typically not what we see in a healthy bull market. As you can see, this is what happened in the 2008 Great Financial Crisis. And then you saw a very nice taper leveling off of loan loss provisions as we had the bull market of 2011 to 2020. We saw that huge spike in during the aftermath of COVID, but then after that, it actually went negative. So they actually had, very, very the opposite effect. But now you can see that this number is escalating quite rapidly here. So American Express and Discover are talking about something that is really not showing up in the aggregate, stock market. But these are things to keep a very close watch on, because this tells you that the consumer is not that strong. Here we can see the aggregate data. This was just published this week by the New York Fed. And we see now that a record number of people, especially young people, you can see that the age group of 18 to 29 as well as 30 to 39 are hitting multi-year highs. You can see that the the Gen Z group, as well as a few millennials in there, are now hitting, transitioning into serious delinquency, meaning 90 plus days late on auto loans, at the highest clip since basically back in 2010. That was when we were still exiting the great financial crisis. This is something that we need to keep a very close watch on, guys. I don't understand why this is not talked about as much, but this is serious data. And, we are seeing delinquencies, not just at, 12 plus years highs, but you can see that the rate of change continues to creep up. And this is now getting to a point where it's going to become problematic for lenders. Remember, lenders are already dealing with a host of issues right now. They still have, a treasury portfolio that's still deeply in the red because they had to deploy record amounts of cash during the depths of COVID at very low interest rates. And now they're dealing with very large, held to maturity losses. Now the Fed has tried to mitigate that with their bank term funding program, BTFP. So they've helped mitigate that problem, but they're also dealing with depressed commercial real estate prices. Remember, a big chunk of especially regional banks have exposure to commercial real estate, and we're seeing reports where a very significant number, I don't have the exact data in front of me, but a rising number of commercial real estate loans are underwater now, meaning the market value of the property is now below the outstanding loan balance. This is a very dangerous combination. And then you have this problem where you have, serious delinquencies on auto loans as well as on credit card loans. You can see that on the right side. The left side is auto loans, the right side is credit cards. You're seeing, a very sharp rise in delinquencies here. And it's now consistent with recessionary levels. We saw this peak around 9% during the depths of COVID. It got much worse to about 12 to 13% during the great financial crisis, but you can see that the rate of change is moving in that direction, guys. And if you combine this with other data that we are seeing, where, for example, the San Francisco Fed, we'll look at that chart, is reporting that excess savings are well below trend now. So Americans have much less in excess savings now than they did a year ago, and they have much less savings now than they did pre-COVID. So this is a very dangerous combination, and I think we need to keep a very close watch on what's happening here. And it just goes to show that there are cracks in the health of the consumer. When we see delinquencies rise, that is worrisome as a bellwether of the health of the consumer. And the U.S. economy is driven by consumer spending. That is the crux of the U.S. economy, retail sales. And this is a concerning trend that's developing in that area. Now, mortgage debt is still very healthy, right? And that is the lion's share of total household debt, right? So therefore, the overall delinquency is still very low. So you can see in gold here is total mortgage delinquency, and that's still very low. It is moving up, but again, very, very low levels here. Nothing to be concerned there, but you can see that credit card delinquencies are again at 11 to 12 year highs, as well as auto loans, reaching, very, 12-year highs here. So, clearly, people are prioritizing. People don't want to default on their mortgage. They would rather, lose their car, for example, than to lose their house. So, we see this happen every single time when consumers are feeling a pinch. They will prioritize their where their payments are going. And right now, they seem to be prioritizing defaulting on credit card debt, which is very dangerous because that comes at a very, very high cost. Some of these credit card interest rates are well north of 15% and 20% in some cases. So this is not a good development at all. So the overall delinquency rate is low because most debt is mortgage debt. But if you look at, ex-mortgage debt, again, that's telling you that, people are feeling some sort of financial pinch here, and that's why they're getting late on making their payments across the board. The job market continues to show worrisome trends. Again, aggregate payrolls ticked up to 1.9% year over year. That's very strong. So you can see that in the teal blue here. 1.9% year over year growth is great. That's usually around where we've always been. In fact, it's actually slightly higher than most of the sort of the average of 2011 to 2020. So let's just call it average. That's typically normal for a bull market. However, if you look at cyclical employment, remember this is a leading employment index. This looks at industries that are much more sensitive to the business cycle than aggregate jobs are. Because remember, aggregate jobs factor in government, healthcare, and education, among other industries. And remember, those three industries are immune to recessions. They're immune to ups and downs in the business cycle. They only continuously grow their headcount. They never cut their headcount. So growth in those industries could be masking underlying weakness in the job market. And that's why I look at and disaggregate total non-farm payrolls from cyclical payrolls. And cyclical payrolls include industries like plastics manufacturing, warehousing jobs, trucking jobs, real estate jobs, temporary help service jobs. These are all industries that start to contract well in advance of economic downturns. As you can see here, the black line, moves into contraction well in advance of the headline jobs number showing the same. So this is a leading indicator. Now, it did tick up, in January. So that is, that looks like it's a good trend. Maybe this is just a small blimp and we get back to growth. That could happen as well. So that is a risk to the bear case that I'm making. But so far, this is now the 7th consecutive month of year-over-year contraction. Now, month over month, it did tick up. So I will say that it's not all bad. And the overall number is still very small. It's just a minus 0.2% decline year over year. So it could mean that the market sees this, but they're not thinking that it's that serious enough to start to jump to the conclusion of recession. And that's kind of what the sentiment is right now, is that even though it is a contraction, and remember, these collective industries never go into contraction, even slightly, outside of recessions. So, if this, ticks back up, it would basically mark the first time since, really 1991 that cyclical industries have cut jobs without us falling into recession. And maybe it's just a very small, drop, and therefore it's not that, statistically significant. So if this number starts to move below, say, 1%, because I actually did notice that, every time we drop below 1% is when the decline starts to accelerate. And so maybe this will start to turn heads if it does drop below 1% year over year. But so far, since the drop is very muted in nature, it looks like it's not that important. However, this is an example of one of the industries that I use in my calculation, temporary help services. You can see that temp jobs, enter contraction. You can see here's the zero line. Temp jobs is a very reliable indicator in telling you when a recession is coming. However, sometimes that can be in advance too, just like the yield curve. This inverted in very late 1999, and you can see that, or actually in late 2000, I should say, and you can see that the recession didn't start until late 2000, early 2001. So that gave you a 1-year advance notice. This time it flipped in 2006, and the recession didn't start until 2008. So we're now in month number, I think it's like month 12. Roughly month 12. I didn't get the exact count here, but you can see that sometimes it can be 2 years in advance. So again, like the yield curve, Temp Help Services is warning recession, but sometimes that warning can be multiple years in advance, like it was in 2006 to 2008. Here's the other thing too. There's been 1.5 million fewer full-time jobs as of the latest January jobs report. An interesting development has been happening, which is that full-time jobs are down 1.5 million since the June 2023 peak. So that means that the full-time job holders count has grown only 0.3% year over year. This is basically the slowest full-time job growth outside of recessions, one of the slowest. You can see this on the chart here. So we're looking at the growth of the total number of full-time job holders in the US. And this is now at the lowest point, basically one of the lowest points. Now we have entered contraction a few times when, outside of recessions, like we did here, and very briefly here. Those were not recessions, but it's very important to keep a close watch on this, because sometimes this could be happening. It could devolve into that happening, or this happening, or this happening. So again, it's very curious that, right now it's being billed as a very strong job market, but full-time jobs are virtually unchanged for the entire 12-month period from January of 2023 to January of now. We've only grown about 0.3%. That's about 400,000 jobs. That is a small fraction of the 3 million jobs that the headline number reports. And that's the number that gets published throughout the media, the press, where 2023 brought 3 million new jobs. But if you look at full-time jobs, that's only about 400,000. That's a very slow growth rate year over year. Here you can see exactly that number zoomed in over the past 1 year, or over the last 2 years. You can see that we hit a peak in June of 1.34 million, or 134 million full-time job workers. We're now down to about 133.1 million. That's a loss of 1.5 million full-time workers. Now, this could be because of demographic shifts. I don't actually fully know the reason for this. We could be seeing baby boomers, for example, retiring, and companies not able to hire quickly to fill their shoes because it is such a big part of the population. That could be an explanation. And if that is the explanation, then this is actually a bullish trend, because this means that we're getting earnings growth with fewer total workers. That's very bullish for margins. So that actually could be a bullish sign. But ultimately, we need to be asking the question as to why this is happening. Again, if it's due to demographics, that would be a bullish reason. That would actually be very bullish for the market. But if it's for the wrong reasons, meaning companies are just cutting full-time jobs and choosing attrition because they see a slowdown in demand for their products, then that would be a bearish reason for this drop in full-time jobs. Now, and because of this drop in full-time workers, the share of part-time jobs as a percentage of total jobs is rising, and therefore you see a very quickly declining average work week. This is now consistent with recession. We're down to the average work week being 34.1 hours. That's hitting lows that we haven't seen since COVID, and prior to that, since the great financial crisis of 2008, 2009. So, this is, again, a number of questions that we need to be asking ourselves. Is there something brewing here, or is it nothing? Is it just due to demographic shifts, or are companies bracing for a slowdown in their businesses? I don't know the answer to that. We also see a very large gap between the household and establishment surveys. This is, remember, every month the BLS publishes 2 job reports, not just one. The one that gets a lot of traction all over the media is the one that the establishment survey tells you, which is the total non-farm payrolls, number of jobs that were created. But the household survey is telling you a much different picture, and that's telling you that the job market is much weaker than it appears. Here you can see a disconnect. You can see the blue line, basically falling close to zero. It's about 0.9% year-over-year growth versus 1.9% for the headline non-farm payrolls growth for the past year. So even though jobs look like they have grown by 1.9% year-over-year, remember the establishment survey can double count jobs. So if you have multiple job workers or people that are holding multiple jobs by an increasing amount, then that could explain it. That's a little less bullish. A little less bearish if that's the case. If that's the explanation, that many, many more people are holding multiple jobs, that might be not as bearish as it looks. But if people are taking on additional jobs in order to keep up with inflation and in order to preserve their purchasing power, that's not bullish. It just means that people have to invest more labor in order to afford the same basket of goods. That would be a negative, in my view, of where we are going as a society. And here we can kind of zoom into that and see the difference there. These differences don't typically rise outside of recessions. And we're seeing a very interesting divergence between that. However, here's the bull case. This is what's kind of the reason why I'm kind of revising my overall view. But job losers remain very, very low. So this suggests that the decline in full-time jobs is happening through attrition, meaning, as people retire, companies are just not filling their shoes quickly as they used to. Now, if that's because they're seeing a slowdown in demand, that would be a bearish development. But if they are seeing a slowdown in demand, then you should start to see permanent job losers rise at a much more rapid pace, and you just haven't seen that at all. So here, we're still sitting at, very close off the lows here, but still, this is not a concerning trend at all. So this tells me that, perhaps that decline in full-time jobs is just due to demographic shifts. So that could be the explanation behind it. If that's the case, then that would be a bullish development, and it'd be very bullish for margins for 2024. Here we see manufacturing. And manufacturing, interestingly, based on the ISM manufacturing PMI, it's still in contraction. This is now the 15th consecutive month as of January that it's been in contraction. But as you can see, it looks like it's forming a rounded base here, and it just hit the highest levels in 2+ years. It took out that high of 49.0 that we saw very briefly before it turned back down. And now, as of the latest reading, it's 49.1. That's the highest level going back to 2022. So it looks like, ISM manufacturing, and again, this, is a national manufacturing gauge. And it looks like it has formed a rounded bottom here. And if this is ready to accelerate, then again, that would be very bullish for earnings growth. And remember, analysts are very bullish on earnings for 2024. They're expecting, north of 13% earnings growth year over year this year versus 2023. And as you can see here, ISM manufacturing shares a very strong correlation to S&P earnings growth, despite the fact that manufacturing is a relatively small component of US GDP. The direction in which it moves correlates very highly with S&P earnings growth or contraction. And so if you can see this here, if we re-enter, plus 50 and remain there for much of 2024, that would be very bullish for the S&P 500 earnings growth. And that would confirm what analysts are expecting and seeing for this year. And here you can see that, zoomed in a little bit further here. These are the estimates for the S&P 500. Year-over-year growth is accelerating. Their expectations are accelerating, looking forward into 2024 and a little bit of even 2025. And you can see that ISM is also improving along with it. So we will see if this is a one-time thing or not, because if you look at this right here, this is a subcomponent of ISM manufacturing. This is what has really fueled the index coming up. The ISM manufacturing new orders, this is a big rebound in January. That was very, very strong. And so the streak ends at 18 consecutive monthly declines. Remember, I've been talking about this. This is a leading indicator, an overall leading economic indicator. And that's now very strongly in expansion mode after 18 consecutive months of decline. So now this is not necessarily the start of a trend, but it is a very strong and welcome rebound. So we have to keep a very close eye on that. Now, one of the reasons why it did rebound, and the ISM survey talks about this, is because customer inventories were very, very low, right? And so, as customers replenish their inventories, they step up their orders. And that's how manufacturing new orders comes up, So we will see if this is a one-time or maybe a two-time rebound before it turns back down, or if this is a permanent swing back into expansion. Because if you look at other indexes, these are regional indexes, the Chicago PMI and the Philly Fed Index, we actually saw that, and that was a head fake. We saw, both of these regional manufacturing gauges, form that same rounded bottom, followed by a subsequent recovery above, into expansion. But that was a head fake, and it just fell right back into contraction. So we had a single month of expansion followed by contraction again. So that could happen because when customer inventories get too low, then of course they're going to put in some more orders, to replenish their inventories. And that, creates a sort of artificial one-time bump in the manufacturing gauge, followed by, a contraction again. So we will see if that happens to the ISM as it did to the Chicago PMI and the Philly Fed Index. Now, here's the other thing too, and this is why I believe that maybe that ISM bounce back could be temporary, because factories continue to slash the work week. Here you can see manufacturing average weekly hours at the lowest levels that we only see in recession. It's exactly at 40 hours now. That's a big cratering from the last month report. You can see that it's down to 40. We only see the average work week in manufacturing this low in recessions. We never see this happen outside of recession, except for a brief moment in 1997 that happened during that long-term capital debacle. But outside of these crazy one-time off events, we never see the work week getting slashed this rapidly, this low, outside of recessions. The yield curve is starting to re-steepen, but again, it has not confirmed that. So therefore, the signal, despite all these other worrisome trends, is no imminent recession right now. It's not imminent just yet. But history has shown that when the Fed gets excessively tight, like it is right now, that does end up breaking something out there. Here you can see a chart of the Fed funds rate versus the 2-year yield. I like to look at this just to tell you where the Fed is versus where the market would like the Fed to be. Because the 2-year yield is a very short-term yield. And so there are, some market, price discovery in that, market but it's still very short term in nature. So there shouldn't be too big of a spread between the Fed funds rate and the 2-year yield. As you can see, typically there isn't a very big spread between the two. And that spread should be positive, not negative. But here you can see this is now one of the deepest negative spreads that we only see just prior to recession starting. Now, we did get here in 1998 once, but typically speaking, whenever things get this tight, whenever the Fed gets this restrictive with rates, that ends up, creating something out there where something breaks in a disorderly fashion. And we see the onset of recession as a result of that. And here we see that happening now. But again, as you can see in the past, sometimes this can happen well in advance of the recession beginning. So again, I wouldn't start to get defensive, and this is what I should have said all throughout last year. I wouldn't start to get defensive just yet. I would wait for that, 10s, 2s re-steepening before the recession call becomes imminent. Here we see the leading economic index. That's been in contraction for 21 consecutive months. Again, that's, calling a recession as well. That should have a bounce back because remember, one of the inputs to that is the ISM New Orders Index. So I think that we might actually see the very first advance when we get that next monthly report here. But again, it remains to be seen whether that is a one-time phenomenon or if it's the start of a new upswing. Here is excess savings. Retail sales have been very strong. That was a very strong print in December. But you can see from the San Francisco Fed, consumers continue to draw down their excess savings, and we're now below the pre-pandemic trend growth in total savings. So this is not sustainable. So that retail sales figure that you see here, in my view, is not sustainable because you can't continuously draw down your excess savings because at some point, those savings get exhausted. And according to the San Francisco Fed, it is projected to basically run into exhaustion at some point in the first half of this year. Here's an update to that. In November, total excess savings from pre-pandemic levels to now is down to 290 billion. And so that is, again, on track to be completely depleted in the first half of 2024. So what happens to retail sales after that, in my view, is very bearish. Gross domestic product. Here you can see cyclical GDP is in contraction versus what we see in the headline number. This is the same thing that I do from the employment numbers. I do the same exact thing looking at the cyclical subcomponents of GDP. Because remember, other components of GDP are not cyclical, like government and education. So I remove those non-cyclical sectors and look at only the cyclical ones. And those are in contraction. And as you can see, they remain below trend as well. GDI continues to undermine GDP. So GDP is strong. We got that number at 3.1% in Q4, as you can see here. That was very strong. That beat expectations. Now, we will see what the GDI number is. This is one of the reasons why nobody looks at GDI is because that comes a month later. So everybody doesn't want no one wants stale data. So they look at the GDP number and run with it. But as you can see throughout 2023, although we got very strong GDP numbers, GDI, look at what GDI is doing. 0, 0, 0.1, minus 0.1. So now we'll see what happens in Q4, but that's a far cry from the growth that we're seeing that GDP is reporting. This is something to keep a watch on because GDI can start to move down in advance of recessions. And here you see that very stark divergence between GDP and GDI. And therefore, the ratio of the two has now cratered to lows that you only see during recessions. So analysts are still expecting 13% growth, but we will see the leading indicators of earnings still suggest that these expectations are overstated. And those forecasts will be marked down unless, and I should give a big caveat to this, unless if we see going all the way back to the ISM figure, unless if we see ISM continue and follow through for about 1 or 2 additional months. But if it turns out that this, bump in new orders is just because inventories got too low, then we're going to see ISM roll over just like Chicago PMI and the Philly Fed Index did. So that would put the bearish earnings trajectory on track. But if we see a rebound in ISM manufacturing, then I would say that earnings growth could be poised for acceleration in 2024. But as of right now, I still think that the trend is down. But that bearish call is under review right now as we see a rebound in the ISM manufacturing. Recessions are always a slow buildup of many things. But again, keep an eye on that yield curve. When it starts to re-steepen after a long time in inversion, that may be the sign of rapid deterioration, which can lead to someone big being caught offsides. Again, banks continue to face tremendous difficulty. Banks are not out of the woods at all. We saw New York Community Bank Corp, crater just last week because they continue to have difficulty navigating the commercial real estate market. They have, again, big losses in commercial real estate. They have rising loan loss provisions as delinquencies rise. All of this is leading to tightening credit availability. According to the NBER, 14% of all loans and 44% of office loans are in negative equity. This leads to almost 300 regional banks at risk of solvency runs. This is, again, coming from the NBER, the National Bureau of Economic Research. This is not what happens in bull markets, folks. And banks, especially regional banks, are dealing with some significant problems that are not resolving very quickly. Here we can see a decline in total deposits. Again, U.S. banks continue to see deposits at lows here. So they have less liquidity to work with. Now, some of this has been mitigated by the Fed and their BTFP program, which is helping them deal with their, the losses from the held to maturity losses from their treasury portfolios. So this risk is mostly mitigated, but you can see that loan loss provisions continue to rise, especially for credit cards and auto lenders, as we saw prior. The net result is tightening credit availability. Bank lending continues to contract. We don't usually see this outside of recessions. And again, delinquencies are rising, as we saw prior. Deep cuts to regional bank earnings. Discover, as we saw, that declined by 10%. And they are a major bellwether for the American middle class with over 60 million cardholders. So again, I don't think that the banking crisis is over yet. Backlogs are still low. This is still bearish for CPI, so I continue to believe that inflation will continue to moderate. New home prices continue to collapse. Again, this is bearish for prices, or actually it is bearish for prices. That's obviously what this is telling us. And again, this is because of higher financing costs. Now, the S&P stays elevated. We're at a 20 forward PE on very optimistic earnings expectations. This is much higher than prior 5% interest rate environments. And as we saw, the Fed is remaining committed to keeping interest rates high. We're not going to get anywhere close to the, the 6 or 8 interest rate cuts that the market was expecting. It might be maybe half of that or even less than half that. We will see, but it looks like with a very high PE here, I have doubts that the Fed is actually going to cut rates. In the March meeting, they may not even cut in the next meeting after that. So we will see. But this is a very elevated multiple in the equity market on expectations that earnings are going to accelerate. Here you see a chart of forward earnings growth expectations versus trailing earnings growth. Trailing as of Q4, was up 3.5% total for the aggregate S&P 500. And that's expected to accelerate to 10% growth year over year into 2025. So again, this looks like a very interesting trough in earnings growth expectations. This is what the market started to forecast as of Q4 of last year. That's what led to this furious market rally, sniffing out a potential trough in earnings growth expectations. And so this continues. If we actually start to see earnings accelerate into 2024, especially ex Mag 7, as analysts expect as of Q2 of this year, then that would be very bullish, and that's why we have a very, very bullish chart. But if you look at the yields versus the 1-year Treasury yield, 1-year Treasuries now yield about 4.8%. That compares to the S&P free cash flow margin at 3.85%. Historically speaking, returns have been muted when Treasuries, 1-year Treasuries, yield more than the S&P's free cash flow yield. So that's exactly what the Shiller PE is suggesting, that the forward 5-year returns may be very lackluster from today's levels. But the S&P, again, from a price action standpoint, remains very, very bullish. And this is very, very significant in my view because, again, if you're a chartist or a technician, which sometimes I am, I do like to become a technician sometimes and take off my fundamental hat because, the price action is one of the best discounting mechanisms in the world, especially for the S&P 500. And, once we discount all aggregate data available, the market could have very said, hold up, markets are very expensive. We're at a high PE, and we see things like deteriorating, delinquencies, credit card provisions, losses accelerating. We see banks continue to face difficulty. The market had every opportunity to put in a double top here, but it didn't, and it broke into all-time fresh new highs. Studies show that stocks that break into all-time new highs continue to set new highs almost a year after that, and that applies to indexes as well. And so this was a very significant breakout in my view. I thought that because of my bearish positioning that we would put in a double top here, but that breakout in my view was very, very significant. And so earnings estimates remain very strong. Analysts expect a cyclical recovery after 6 quarters of decelerating growth, as we saw in this chart right here. We saw continuously decelerating growth, but now looks like we're seeing a trough in that earnings growth expectation. It hitting at minus 2.3%, but we're seeing that reaccelerate into 2024, and they remain strong through today. And so again, analysts expect cyclical growth recovery in earnings growth. They expect accelerating earnings growth, increasing at an increasing rate of change. There's also at the same time strong evidence of disinflation across various measures. We see housing prices moderating, used car prices moderating. Commodities have basically cycled back to long-term averages, like for example gas prices and other food commodities as well as other energy commodities. They're basically back in line with where they have always been. So there's very strong evidence that inflation remains very, very tame, and every other piece of evidence points to inflation getting back to the Fed's long-term target of 2%. So that is what has triggered easing long-term bond yields. So again, we've basically put together a Goldilocks blend of conditions: easing inflation, easing long-term interest rates, accelerating earnings growth expectations. Together, these three are basically creating the conditions to fueling this powerful market rally. And that's why we had this big breakout here. So again, despite the bearish data points that I presented to you, my conclusions are that and here's where I have made a big change versus prior webinars here. The direction of leading fundamental economic indicators at the margin implies negative pressure to S&P earnings. This implies that my current expectation is that analysts will mark down both this year and next year's earnings forecasts. And at the same time, markets are priced for earnings growth at a forward P of 20. That's 20 times very elevated expectations of earnings for this year. If that doesn't happen, there will be a substantial drawdown. But because we have, very strong expectations of earnings growth, because it looks like we have put in a trough in earnings growth followed by a cyclical recovery in earnings, and because we see disinflation, because we see easing long-term bond yields, the market is pricing in a soft landing, and that's why we have seen such a powerful breakout that we saw early this year and late last year. So here's what I would do. I still think that the end result of all of this is recession. But as we saw from the yield curve, from other factors, other leading indicators like the temporary help services, like cyclical job growth in contraction, these tend to have a very leading nature in them. And so we could see, another entire year of, solid market gains. So I would wait for a much, sort of closer indication that something is imminent, where the yield curve re-steepens from the prior inversion. And for the S&P to drop below a medium-term moving average, like the 12-month moving average, for example, for optimal recession timing. You can go back to this chart and see that, every time the market drops below, for example, the 12-month moving average, that would be an indication to sell, and that would help you avoid a much larger drawdown. And then you simply buy back upon a recapturing of that 12-month moving average. If you sold here, you would have avoided this major drawdown. And then if you bought back, even though it may have triggered a little bit of trading in and out, you would have bought back here, and you would have been participating in this entire upside that we have seen, this powerful breakout that we saw this entire time. So this is a great sort of risk management tool that you could use. So I would basically combine this with the yield curve steepening. So if we see a rapid re-steepening of the yield curve, followed by a breakdown of the 12-month moving average, if we see a weekly close below the 12-month moving average, combined with a re-steepening of the yield curve, that is when I would start to get very, very bearish and actually make changes to the portfolio. So that's what leads to this final slide here, my ideal capital allocation for this year. This is my big call and a big change from where I was before. Remain long risk. And this is actually what I have been saying in my writings. If you follow my weekly column, published on Zacks.com, accessible in ZRS as well as in advisor tools. My weekly market analysis report. I have been saying this, but I wanted to start adding this to my video webinars as well. Remain long risk. Remain long the S&P 500 and the NASDAQ 100 as long as it trades above some medium-term moving average of your choice. You can use a 12-month moving average or the 30-week moving average. I like both of them. You can use either one, but pick one and stick to it. So stay long it as long as it trades above it. And then close out that long position and go defensive when we see a rapid re-steepening of the yield curve and a weekly close below that moving average. So if you see the combination of those two, I would start to position very defensively. And the way that I would position defensively is to have just 1-year treasuries and the Zacks earnings certain portfolio, and focus especially on the ones that have low beta, the ones that have strong dividend growth and share buybacks, and the ones that trade at a low Shiller PE. So basically position for a low growth environment when that happens. But for now, remain long risk. This is a very powerful breakout, and I think this is something that cannot be ignored. So I would keep, remaining in the S&P 500, driven by the Mag 7, but get very, very bearish very quickly when that yield curve re-steepens above zero, because I think that there are trends in place that continue to signal recession. It's just that the recession is not as imminent as I thought it was originally throughout 2023. And that's why the market continues to set new highs, because these trends that are building here are not yet powerful enough to really impact earnings expectations for this year and next year thus far. So I hope you found this helpful here. Again, if you have any questions, I'd love to hear from you. You can reach me or you give us a call at 1-866-794-6065 with any questions, or send an email to strategycall@zackspro.com. Again, I apologize for the very long video. If you're still here, I really appreciate your time, and I hope you found this helpful. Again, I'd love to hear comments and questions from you, even if you disagree or have spotted a mistake somewhere in here. Again, please do reach out to me and let me know about that. Strategycall@zackspro.com. All right, take care, everyone. Have a good one. Bye.